Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and here's a question I get asked so many times on my Patreon account and also in our YouTube comments area. Which is better of the S&P 500 ETFs that I want in my retirement account? Goldman Sachs GPIX or the TappAlpha S&P 500? Well, we're going to break it down today. We're going to give you how each one works, what their cost and efficiency is, and really what's built for your future. So two very top ETFs. I can't say we're going to have a bad one in either one of these mix, but one is a better choice for retirement the way I see it. So let's get into today's video. Now, I do got to put a self plug out here. We have our Retirement Made Easy Living on Dividends coffee mug. Now, this one here, this is really, we do this to support the channel. You can follow the QR code, or you can just, down in the description, you'll see a link right down there that you can link into it and buy it right online. It will ship them right out for you. They're running low. I hate to tell you this, but I cannot believe. Thank you so much for the support. Our coffee mugs have gone very, very well. We've had other people ask for different things, so we're going to start adding some more things using our logo and trying to help grow the channel through different support. But thank you, and if you want, get a coffee mug, makes perfect gifts. So let's talk about the retirement income dilemma. We have two funds, both of them doing the same mission. Which truly serves the right to the retirement accounts? So both GPIX and TSPY offer the S&P 500 exposure with that monthly income. Both their mechanics are very different. Inside retirement accounts, these differences can significantly impact your long-term outcome. So what most people really want is they want reliable income. How much can you count on each month? And you also got to have growth. Now, I know a lot of people talk to me differently about this, but you have to have growth. That is, will keep up with your inflation, will keep up with the cost of money today. So you got to have some kind of growth to it. And then you have to have that risk and cost of what they're, giving you. What are you really going to give up to get that income is that risk and cost. High yield is not always the best for retirement funds. The income today and the growth for tomorrow, that's the real goal. So we're not going to chase yields. We're not going to chase, oh my God, I'm getting 30% on this one or 15% on this one. We don't do that on this channel. We don't chase yields. But what we do is we give you some great funds for long-term financial development. So our first fund, GPIX, the Goldman Sachs S&P 500. Now, we understanding GPIX, this fund's goal is monthly income and capital appreciation, a true total return income fund, not just a high yield chaser. Okay, they use a dynamic option coverage, which writes covered calls on 25 to 75% of the portfolio, and it adjusts its covers to balance the income generation versus upside participation. So what I'll explain to you a little bit in this, as the market, if we're into more of a bull market, they will cut their coverage, their option coverage down to basically, I'll call it that 25% category, because they want the natural growth, that generation of participation of the fund's growth. They're going to let that thing run, and they're going to let it run naturally. As we get into what I call a swampy market where we got a lot of volatility. We got a lot of volatility up, down, every which way. They're going to open that option coverage up even bigger to generate more income, because the growth technically is not there. When we get to a bull market, man, we're going all the way, to a bear market, we're going all the way down to where they're going to be opening up 75 to generate even more income. It's worked very, very well with their system. Their expense ratio is 0.29 expense ratio, 8% range on the yield, but the fund has $4.4 billion in assets under management. So GPIX balances income with growth, and inflation doesn't retire when you do. So it helps you continue keeping your growth up in your particular fund. When we take a look underneath the hood, like I said, assets, $4.4 billion, very low expense ratio, 0.29. I expect that to go up to probably about 0.35 here, probably within the next 6 months, to be honest with you. Just things I'm reading for what's going on. They have inflationary costs as well. 84 million shares outstanding. It's paid $4.45 in dividends over the past 12 months, a yield of 8%. This fund came out October 24th of 2023, so we're really sitting here just shy of 3 years of being out there. And the price range, 55.20 to 55.65 in the daily price range. So it gives us about 11.88% growth over the past year. So when we look at the numbers, you're looking yield, okay, 8%. Growth, another 11%. Very, very strong. When we start taking a look at the total return numbers now, this is where things really start getting interesting, where I say this is a very interesting piece. Since inception, 23.44%. So remember, that's almost 3 years. 1 year category, 21.83% total return. Year to date, 9.83. Now, in the past month, it's down 0.27. It's because of the market. We had that drop off. We had that, as I always call it, the W, then the M, and then we went flat. Now we're coming back up again. Now, TSPY, the TappAlpha S&P 500. Now, this one here, they call this the daily income, and I'll explain to you. It's not paying distributions daily. What they're doing, though, is how part of their strategy. Now, the TappAlpha TSPY is an aggressive income harvesting through 0-day to exceptions options every single trading day. So the goal, that S&P 500 exposure and that high monthly income via daily option strategy. So their strategy is they hold VOO, which is the index S&P 500 index, and they write daily SPXW0 DTE call options, harvesting the time decay every single trading day. What this allows them to do, and this is where the daily comes into, they're actually every day operating that they can change their strategy. They can change their writing positions. If they see the market is having a downward trend, they'll write their options differently. If they see it going bull markets, bear markets, they change as the market changes, all trying to cut into that short little snapshot window of 0 days. So basically 24 hours to get this done. And that's how they're getting their income harvesting. Has it worked? We've seen a lot of different funds do this. Their twist is putting that daily mix to it, and it has worked. 13 to 14% of high monthly income in their distribution rate. Now, the expense ratio is definitely going to be higher than what we've seen with TappAlpha. With Goldman Sachs. So let's dig into it, pop the hood, and see where we're at. $286 million in assets. So a smaller portfolio, smaller fund that's been out there. They have 11 million shares outstanding. Their expense ratio, as I've said, was 0.71. So a huge difference between 0.29 and 0.71. $3.55 is distributions, which is not far off from Goldman Sachs, but a 14.01 dividend yield over the past 12 months. That's where we're talking the big difference there. The other thing you look into, the fund runs between a $25.16, $25.38 daily range with a high of $26. We look at their growth side of it, and their growth side of it, even as they're following the same exact pieces underlying of the S&P 500, and you can see the chart says the same thing, they've only had a 3.71% growth. So this is why I say TappAlpha is designed for income across the board. When we look at 16.58% since inception, 19.52% total return in 1 year, 6.6 year to date, and this one's down 2.14. So their strategy in this muddy market is worse than what GPIX has done. So there's that reward trade-off I talked about. To get that big dividend, you're giving up your growth. You're giving up some of your total return. So you really got to pay attention. What is your actual true yield coming from TappAlpha? So let's do the comparison, income and yield. Okay. Now, TSPY, I just explained, has that strong 14% distribution rate, has a higher monthly cash flow. It's powered by those zero DTE options, and it's very attractive for income-focused investors. Now, GPIX has that 8% distribution, strong income versus the traditional S&P 500, has a balanced income and growth, and doesn't change maximum yield. So it gives you more a balanced approach. This is why I always say you don't always chase yield. You got to make sure you're looking at the total return of this, because right now, I know you're sitting there saying, well, TSPY is definitely a better option. It's a less expensive fund. It's paying more dividends. Boy, I'm all into this one. Then you're probably an income-focused investor. Now, personally, I own both of these. And you'll be questioning yourself, why does he own both? And I'll explain later, but I own both of these, so I really give you the inside feel of this. Two, the expense ratios. And that's that long-term cost. Now, all the numbers I show you have these numbers included into it. So it's not like, take another 0.3 off or 0.7 off of the numbers I'm giving you. They're already pre-programmed in. So GPIX saves you that money at 0.29%. That is putting more money to work for you in long term. If you take and have the fund for 10, 20 years down the road, these numbers really start coming into effect, where you'll see thousands of dollars difference in a portfolio because purely off of expense ratios. So GPIX is that actively managed, which is very inexpensive for 0.29 strategy. Very competitive in its category, and it's a single clean fee. There's no layered costs in mixed of this. Now TappAlpha, it includes the VO underlying fund expense. That's why you're seeing this higher. It's not that they're trying to take more money off the table. There's more costs of what they do. The cost that exceeds that GPIX with layering, and the cost compounds returns over time. So there's added fees for how they do their daily and covered calls. So like I said, over 10 to 20 years, big difference. Just looking at right now, I don't make a decision saying, oh, now we got to go to Goldman Sachs because of an inexpensive expense rate. Now, fund size. This is something that a lot of people have asked too. Why do you worry about fund size? Well, this is what we call liquidity and stability. Right now, GPIX has $4.4 billion under assets. If they decide to do something different, we can get a call sign. We can watch those assets start to slowly drop off. Then we know something's wrong with the fund. Same thing with TappAlpha. At $286 million, the timeline's much shorter. But at the same time, we can watch these assets and say, oh, they're starting to drop off. Or are they continuing to grow and people are getting more and more involved into it? Established multi-billion-dollar fund and a high trading liquidity and tight spreads, a deep market confidence and acceptance. It just tells us that people are very comfortable with what they've seen for long term of the Goldman Sachs package. Now, TappAlpha is actively growing, but it's a smaller than the GPIX. It's shorter track record, no full bear markets in their cycle. So less liquidity is a big thing for large retirement positions. I'm not saying it's bad. I'm not saying either one of these two will jump over here because of the assets. Both of them are very good. It's timing. It's how much the funds are growing across the board. Now we get into this whole growth side of it. Every retirement portfolio needs growth. I said that before. You need to cover, definitely what we're at 3% inflation rate. You need to be above that. TappAlpha is doing that just almost perfect to the par of getting you to that just a hair over 3% to help grow your fund. Okay, but that 11% for GPIX, taking a little bit off of the yield and putting it more into growth, it questions where are you at in your portfolio? Are you still a person that needs income all the way through? Well, then, yeah, TappAlpha is probably the stronger way to go. But if a balanced approach, which a lot of retirees like to have, GPIX gives you that strong growth side of it over the past 12 months versus what TappAlpha has done. Total returns now. Total returns is what tells me what goes on in a fund. Now, what does it tell me? If I'm in big positive numbers, double digits like you see here over the past 12 months, 21.83% versus 19.52%, it tells me right off both funds are very healthy. Okay? Both funds have had a very strong 12-month period. Now you can break this down into 6 months. You can break this down into 3 months. You can look at it month by month of how their total return has come through. GPIX gives you that 21%. That's a true return. So that means if I put $10,000 into this, okay, and getting that 21% return off of it, I'm going to have $2,100 growth from income and from the growth package together. I'll have $2,100 of that. Now, when we look at TappAlpha, same thing. You're going to have $1,952 of growth in your fund value. Now, where's it coming from? Well, we know only 8% of it's coming from yield from GPIX. We know 14% is coming from TappAlpha. So you can start calculating out who's built for income, who's built for growth, and see what happens. If this TappAlpha number was down to, let's just say 11%, we know if we're supposed to be getting a 14% yield and the total return is only 11, that means 3% of our yield is actually getting put back into the fund. So this is what tells you if you really have money or you not have money. Do you really have income or not? That's why total return is the first thing you got to look at. Where are we at? What positive numbers are we up? Same thing with GPIX. If it was all growth money, then we're not getting income. So the strategy deep dive, this is another one that I really start looking at and say, which one fits your needs and your position? I call it the conservative core versus an aggressive income. Now, this is what's funny. This is kind of an argument that I have with my brother all the time. He is a very conservative person, and I'm the old aggressive guy. And we go back and forth, back and forth. And it's funny how two people in the same family have this difference in around. But it's not that neither one of us is wrong. It's just the different way of playing the field. GPIX Goldman Sachs is a balanced approach. I personally do like this approach. And I know he does as well. Because of that dynamic 25 to 75% option coverage, the balance of income and capital appreciation, and we're not chasing the highest yield, and the total return focus, very, very conservative core base here. When we go to TappAlpha, though, this is where we're looking for that aggressiveness. We're looking for those 0 DT options, those 0 days. We're harvesting time decay on every single trading day, and we want higher income targets. We're not looking for growth. This is where the aggressive investor goes to. Okay, so where are you sitting at? I always call this the hard S&P 500 rallies can cause TSPY to miss some big upsides, while GPIX preserves more room to grow, but you may lose some income side of it. Now, growth potential and the NAV stability. The higher yield can come with a cost. Now, I kind of talked a little bit about this, but GPIX has more room to grow. The lower yield targets and preserves the upside protection, while the S&P 500 gains flow through more fully in their system. NAV stays healthier for over long term. So again, growth potential very strong. TSPY, because it's built for higher income and it has that bigger trade-off, the daily 0 DT call options caps that strong inter-day rallies. Okay, so you're going to have a lower growth potential, but a higher income. That's why putting these two together, everyone always asks this question, which one do you want to go to? And it comes into what you want in your portfolio. Now, tax treatments. Now, inside an IRA or a Roth IRA, the strategy, the quality really doesn't matter that much of the characteristics breakdown because the IRAs protect that. It's when you get into the brokerage funds, which becomes very critical. It becomes extremely critical. And that is the traditional IRA, not taxed on the annual on the distributions. Okay. In a Roth, the qualified withdrawals can be tax free. What really actually matters is the total return, the NAV stability, and the income reliability with those fees. Now, in tax side of it, both of them are going to use the ROC package program, okay, which is return of capital. So when you get into a brokerage fund, you have to just understand what part of the ROC, which means you're not going to pay fees till you, which basically liquidate your fund. Some of the risks that we need to talk about. Now, GPIX, the bull market underperformance, the dynamic cover call overlay may cap the upside during the S&P 500 rallies. Income versus growth trade-off. So remember, you're going to have lower income, higher growth, and market equity exposure. If the NAV drops when the S&P 500 drops, option income soften, and it doesn't eliminate your losses. It can kind of help a little bit. So we always call this a risk level moderate. TappAlpha, there's a lot of things that we risk about with this one. It is definitely a higher risk. It's still in the moderate frame size, but it is definitely higher. Is you're going to get that higher yield and the higher trade-off. Okay, that means you got to watch your growth. If you don't get equal growth, you're going to be cutting into your yield. Doesn't have the full market cycle history yet. And that zero TE strategy is very sensitive to the S&P 500 rallies and drop-offs. Now let's take a look at the retirement scoreboard here. Which fund wins each category? If you're looking for income and yield, then TappAlpha wins this with that 13 to 14% distribution. If you're a person very concerned about expense ratios, that you're going to hold something for long periods of time, well, that 0.29 is the lowest cost you're going to find in a lot of S&P 500s. So that's where the Goldman Sachs wins. If you want fund size and the liquidity that you don't have to worry about a particular fund, Goldman Sachs is going to win this too. Now, the strategy simplicity, well, with that balanced approach in income and growth, I got to lean over towards the Goldman Sachs. Now, TappAlpha has its strategy, has a strong system, but when you put the word simplicity into it, and I get all these words from what people ask me, so we kind of put it together for you, the viewer. So the higher income potential, hands down again, TappAlpha. And long-term core holdings, I always put it with GPIX. The stability and the growth blend together just makes it for that long core. Now, if you're an aggressive income and you want some boost to your portfolio, then the TappAlpha wins again with that high yield. So 4 wins for Goldman Sachs, 3 wins for TappAlpha. Now, wins don't automatically mean best choice. It's the context and the portfolio role that you want the fund to play. So here's my personal verdict on all of this. Why GPIX is the better core holding. Now, I use this as my core, one of my 3 cores in my income portfolio. Remember, I have a foundation fund, a growth fund, and an income fund. And inside the income fund, I have funds that I will never sell, I'll never do anything with, is what my core holdings are for income. And one of them is GPIX, is a core retirement holding. I love the balanced income and growth. It's built for the long game. I know the 8% doesn't turn a lot of people on in today's market, but 8% is almost, I can sleep on money. I can go to bed, not worry about it. I have the money coming in. I have a multi-million-dollar asset under management with a very, very low expense ratio. Everything on here goes all the way back. It's institutionally backed. Goldman Sachs active management. So let them do the worrying. I always call it let them do the driving. The NAV stability, I'm not worrying about NAV erosion on the particular funds. I have income and growth, so I'm not sacrificing my NAV yield. I'm not sacrificing anything across the board. So I really like the way this one is, and that's why it became my core. Now, I told you earlier, I own this. I own TappAlpha TSPY. And I use this as what I call an income booster. It's a satellite piece, not a core piece. And satellite is an add-on to my income side of it. I have a smaller portion size paired to GPIX as I call the anchor. And I let TSPY amplify my income without dominating the risk exposure. Okay, I'm going to take that 13, 14% and use it to boost my 8% up to maybe a possible 10% total number. That zero DT option strategy works great. And the understanding of the risk, that's why I make it a little bit smaller portion. So I right size my position that works best as a smaller sleeve, not the full retirement replacement, but a smaller sleeve in my portfolio. So the strategic portfolio construction, realistically, I'm not going to argue with anybody with these percentages across the board, but realistically, I'm probably 75% GPIX to 25% TSPY when I'm dealing with these two funds as a whole. I want the core holding. I don't want to worry about it. When I'm sleeping, I don't want to worry about money. I don't want to worry about it. I just know I'm going to get my paycheck from GPIX with no problem. I take TSPY. I know we're going to have some volatility. I'm going to have some ups and the downs, but I'm going to add to my portfolio that will give me a nice balance between the two. Hopefully gain maybe about 2 percentage points from the 8% you get from GPIX. And then the growth will help with TSPY across the board. So my whole key thing is building a dependable retirement paycheck. Retirement investing isn't about the highest yield. It's about the most reliable income without destroying your portfolio behind it. This is why these two funds, I think they're both awesome funds. I think they're both great if used properly. You've heard me say this on the channel before. You got to get the right people onto the bus. And then when you get the right people on the bus and get them in the right seats, you have the best bus ride you can ever have. And same thing here. If I put the right people in my portfolio, and if I put the right funds in the right spot in my portfolio, I get a paycheck coming in. Income today, I got growth for tomorrow, I got NAV stability, I got the future dialed in, I got it taken care of. Let me know what your thoughts are of all this. Which side are you actually on? Are you on team GPIX or are you on team TSPY? Are you a big income guy and you want all TappAlpha? Or are you one that's in the middle, want to drop both of them behind it? Let me know what your thoughts are. Drop me a comment down below. I'd love to hear from you, how you use these two. And if this helped answer all your questions, anyone who's left questions, does this answer your questions about who's the best, GPIX or TSPY? If you like the video, hit that like button. Also, don't forget about our coffee mugs. We're running low and running out. Just to help support the channel. Thank you. And if you're not a subscriber, hit that subscribe button.